Busy week ahead for the markets with inflation data and bank earnings on the agenda. Joining us now is Sylvia Jablonski, Defiance ETFs co-founder and CEO. Even though we've seen some, I don't know whether you call it anxiety or maybe skepticism about the 50 basis point cut in relation to what that jobs number we saw on Friday. You're taking it at face value, I think, Sylvia. Soft landing, rates coming down, earnings staying strong, inflation under control. It's all a green light for you for stocks?
It's all a green light for now. You know, I think the U.S. job numbers beat expectations on all fronts. Wages looked good. That tells us that the consumer will likely continue to spend, which feeds the economy. You know, the S&P 500 is up about 20% in 2024, which added $8 trillion to market cap. I mean, it's hard to argue that it's a bad year and that a recession is looming. So I think earnings are strong. The Fed has been, you know, favorable to markets, supportive of markets, at least, you know, with the last rate cut. It is projected to be the same depending on data going forward. And I think earnings are looking pretty good. We're expecting 4.7% growth year over year. You know, people are working, jobs are strong, and earnings are good. I think that bodes well for a soft landing and a bull market into the year end. You know, barring any kind of major issue, which we do have some caveats there with what's going on in the Middle East. We don't know what happens there. But barring, you know, that kind of escalating further beyond what we expect, the market could end up rallying into the year, I think.
How do you explain that the Fed thought it was necessary to go 50 basis points with some of these recent numbers now apparent to us? We didn't know, the Fed obviously didn't know what the Friday employment report was going to be, or does that make sense to have so much of their concern now aimed at the employment picture rather than the inflation picture?
You know, I think it's a tough call for the Fed. I don't envy their position, right? I mean, we kind of criticized the Fed for not cutting in July, not cutting quickly enough because of the data that they had, which looked like it was kind of looming in the wrong direction for job stability. And, you know, now here we are with a positive read, and now we're saying, you know, you overdid it. So I think, you know, I think it was the right move on their part, given the data that they had at the time. And going forward, they're probably going to continue to be data dependent and look at, you know, every read going forward here. And they might change, right? With again, what's happening in the Middle East, we have to look and see what happens with oil prices, how that impacts inflation, the strike of the longshoresmen. You know, that's put off for a little while, but some of these things could be you know, turning inflation the other way. So I think the Fed will be data dependent, but they did what they probably should have done given the data they had in front of them from July and June. So we'll see.
Well, what does it mean about the next meeting, the meeting after that? Would you cut again? Would you pause? Would you do 50 again? What do you think? Or is that, once again, it's data dependent?
Yeah, I think it's data dependent. When you have a jobs number like we had on Friday, it's tough to make the case that they should cut again by 50. And so, you know, I think that it would be reasonable for the Fed to potentially do nothing in the next meeting, or perhaps do a smaller 25 basis point cut and then wait and see. I wouldn't expect them to do 50, though, just given what we saw Friday. The data is a little bit too good, I think, to do that next cut at 50.
Is it going to be the same old leadership? If we continue to trade higher, still going to be led by the tech stocks and the big names?
Yeah, so I love the tech stocks. I love the big names, but I really like dollar cost averaging into them on pullbacks. And when you have market events like today and you know, potential hits to the NASDAQ, I like to go into those names. But overall, I do think it's time to start diversifying portfolios and looking at the XMAG. So that's, you know, the S&P 500 minus the top 7 names. And the names you're looking at there are names, you know, you talked about Eli Lilly versus Pfizer and putting up a chart in the last segment. Eli Lilly is a great stock. Exxon is a great stock, right? They pay a great dividend, diversified into alternative energy. With the Middle East crisis, you have, you know, the price of oil spiking and things like this. But in general, if rates are coming down, whether we don't, you know, maybe we don't get that next 50, but rates came down 50, they will be coming down over time. I think you have a good case for small caps and good value mid caps to start to rally. And then, you know, the kind of like unloved S&P 500, the Mag 7, has actually been performing. I think it's worth investors diversifying their portfolio for the longer term here.
What about the Russell versus blue chips in the S&P versus international. All boats are going to rise. What about China? Did you see David Tepper?
Yeah, I mean, I don't think all boats are necessarily going to rise. When I look at small caps, I try to think about looking at the quality small cap names. But the S&P 500, ex the Mag 7, you still have a lot of solid large cap blue chip quality balance sheet companies that pay great dividends. And I think that it's certainly worth having that diversification there. China remains to be seen. I mean, we've seen this short-term rally. They're essentially easing, supporting their economy there. We'll have to see what happens. Second largest economy there. That also helps us too, right? If you think about names like Exxon and Chevron, which are ex-MAG, if the second largest economy starts to grow, they're providers there. You get some growth there too. But I do think it's worth it to start diversifying out too. Like Japan was a good diversifier. Now perhaps it's China as they have some of this stimulus coming in. And maybe the Mag 5 of Europe is interesting to look at. Some of the top names in their broad-based indices that have been sleepers for a few years.